This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Justin's picture that says, looking for the downloads. Eric, let's cover crude oil, starting with EIA inventory.
EIA printed a drawdown of 6 million barrels of crude oil. Now, that's, of course, just about perfectly erasing last week's bounce, which was a build of 5.9 million barrels. And, of course, that came on the heel of 2 weeks ago. We had the biggest drawdown in recorded history. Cushing, Oklahoma, drawing down 837,000 barrels. So again, we see the same phenomenon there of a big drawdown offsetting the much smaller bounce that we saw of 159,000 barrels last week. Gasoline drawing down 261,000 barrels. Distillates building 296,000 barrels. So on the finished product side, we're basically balancing each other out, really no change. We don't have the big drawdowns, but we do see them on crude this week. U.S. production ticked up another 100,000 barrels to 12.7 million barrels. So we were struggling, couldn't just get past 12.3. All of a sudden, wham, we got to 12.7. Boy, they must have really, put some more rigs to work. No, I think it's an anomaly in the reporting. One of our listeners who's deeply into the industry has shared with me in email that his data has for months now been suggesting that 12.6, 12.7 is more like the realistic number. And those lower numbers that we were seeing from EIA were probably wrong. Don't know if he was right or not, but certainly the data that we're seeing now seems to confirm that he was. So, Mark, if you're listening, thanks for the tip there. We'll see what happens. I do think it's very important to see whether or not U.S. production can continue to grow, because frankly, there's no other plan for how we're going to get enough oil supply to meet growing demand and get the economy back to pre-pandemic growth trajectory unless we increase production someplace in the world. If not in the U.S., where else is it going to come from? And with all of the ESG policies, there's good reason to wonder if we're going to be able to grow production. So this is definitely a very good sign that we're seeing larger numbers in U.S. production. I hope they continue. Overall, big picture, just as we anticipated last week, we had been through a lot, 6 or 7 weeks in a row of up. We were overdue for at least some kind of pullback. Finally, we're getting it. So far, as I'm speaking, we're looking at just over $79 on WTI. That's down from almost $85 at the peak. I think we're probably headed back down to 77 before this correction is over. That would be the 200-day moving average in the continuation chart. If that holds and we resume the rally from there, and then if we take out $85, that would really be the signal that the upside rally is in place. The question is, how much farther does it have to go? Our friend Anas Al-Haji is reiterating his call that it does not go over 100 this year. I still think there's some more upside to it, but I think probably 2024 is going to be the really big move year for a new uptrend in crude oil prices.
Well, Eric, it has been an epic run. Over the month of July, about 6 weeks altogether, crude oil ripped $17 from trough to peak. And it was inevitable that we were going to have a retracement. This is the very principle of how markets work, like ebb and flow. And a typical pullback could be as much as a 50% retracement. Obviously, a much more shallow one lies right around those moving averages, that $77 level where you had. And the way I look at this is it traditionally would be a buy on dip on any first pullback. So as we get to these levels, the way I look at it is the higher that the short-term bottom comes in, the more bullish it is. And alternatively, the deeper oil corrects, the more likely oil is going to be maybe still stuck in those trade ranges of 2023. Now, my first view here is very similar to your 77 level. I think where all those moving averages lie around the 75 to 77 zone should contain the initial selling. and I'm going to be looking to see whether a buy on dip develops here. Well, the most bullish thing that could happen is that within a week, we see crude oil trading back into the low 80s and just completely reversing all the short-term weakness. And that demonstrates that a new round of accumulation and dip buying is becoming quite evident, and that trend could very easily continue from there. Nonetheless, what's your thinking here on the equity markets?
Well, the market's been selling off for a couple weeks now, and we've taken out the 50 and 55-day moving averages to the downside. So 4306, which is the 61.8 fib retracement level for the overall bear market, that was my prior top target for the bear market rally. Obviously, I got stopped out of that trade. Maybe that's going to be retested as support soon, and whether or not that holds is going to be critical. So I'm still persuaded by the bear fundamental arguments, but what we've seen pretty consistently is those bear fundamental arguments made perfect sense, and the market just kept rallying. It seems like it's finally done and rolling over, but the question is rolling over how far? Let's wait and find out.
Well, let's get Nick involved in the conversation here. And Nick, what are the technical levels? You're starting to watch now the September OPEX, right?
Yeah, that's correct, Patrick. Yeah, so for the September OPEX, current spot price is 44.05 on SPX. The expected move for that OPEX is plus minus 150 points. So right now, the upper expected move would be 45.55, and the lower expected move would be 42.55. There's currently a call wall above at 4,500 and a put wall just below at 4,400. And we have key resistance above at 44.50 and key support at 4,400, 43.50, and 4,300. I'm inclined to think that over the next month or so after Friday's OPEX, that being August 18th OPEX tomorrow, we're going to see a large move in either direction, either up or down by about 100 points over the next couple of weeks as gamma rolls off. I'm thinking downside perhaps to 4,300 and pretty fast if we do break that 4,400 mark. So for the time being, I'm a bit of risk off right now.
Nick, I agree generally with your levels, but to me, the key level was already broken. Last week, we talked about the idea of how important the 4,500 level was. It was either going to be, in my mind, a very shallow, 5, 6, 7 day correction that held at 4,500 and would be used like a springboard to launch a retest of the highs and or even punch 4,700 on the upside. But if 4,500 was given out, was what we were talking about, then it opens the window to following a deeper and more prolonged correction similar to the one we had in February, March. That was that 300 to 400 point variety that takes almost close to a month to play out. And with the break of that 4,500 level the way we did, in my mind, that has now made it clear that this is not one of these short 5-day kind of little quick 100, 150 point pullbacks. And so now, if we just use the base case of the analog of how the February-March sell-off played out, then it comes to that same level you just talked about, which is around that 4,300, give or take. And I think that at this stage, on balance of probabilities, the market is very likely heading there. Now, it's not going to be a straight line. We've had so many of these day after day sell days that typically one little upside rip at some point, a 50-plus point day, just to check the decline and stop out anyone who's got stop losses a little too tight is a very natural reaction. But right now, this coming down toward 4,300 is what I suspect is the path of least resistance. The other noteworthy thing is that a lot of the previous highs throughout the first and second quarter were all developing around 4,200. The point is, I'm actually not so sure I'm so bearish that I think that we're going to crash here or something. Even if we do drop another 100, 150 points, I think that it will be bought on dip, and probably going into the first weeks of September could send the market easily into a 1-2 week rally, taking another stab at retesting previous levels up above before we see a bigger topping formation develop. And so a little bit more short-term weakness, just in line with what you were thinking. Nonetheless, let's get it to the Qs. What levels are you watching on the NASDAQ?
Spot price right now on the NASDAQ on Qs is 363. Now, the implied move for the September 15th OPEX is plus minus 17 points. Now, the upper expected move there is 380, and the lower expected move is 346. We have a call wall just above at 370, and we have a put wall just above actually where we are right now, which is actually interesting because if we close below this level, it's possible we shoot down more and test out key support level of 355. Key resistance right now is at 370, then 380, and then obviously at all-time highs just above. But again, as I said in previous weeks, I'm pretty bearish on big tech. as it's had a pretty serious run this year. And I do see it coming down if the market sells off. And I see it actually underperforming the broad market as a whole as well.
You know, the interesting thing is that that June 26th low on the Qs basically still has actually not been violated, but we're at least trading down into it. But when you're looking at the S&P 500, it's actually still well above those that June consolidation low, which just continues to show that the distribution in the Nasdaq is dominant. There is definitely some sort of sector rotation going on. We saw some of the flows going into obviously energy, into healthcare, and certainly out of the big tech. And that's going to be interesting to see whether that trend persists throughout this entire cycle. But what's been most surprising to me, Nick, is that even though we're breaking some key technical levels and clearly the selling is starting to emerge, I would have already suspected that the volatility index would have traded back into the first quarter of the year levels, which is around the 20 level. And that's not, we're talking about like where the fear index is blowing out 25 and we have everyone grabbing at huge volatility premiums to hedge at any cost or make downside bets at any cost. But to be still at the 16 handle with this prolonged round of selling, I'm asking the question of whether that somehow signals some degree of complacency that not everyone yet thinks that this is anything that's going to be a big deal. It certainly does not give me any short-term signals that suggest that a market low may be imminent any day now. What do you make of this lower VIX level here?
I agree with your assessment that this indicates a lot of complacency. For one, this level of VIX around 16 or so denotes that we should have 1% daily moves on SPX. And what this indicates to me is that we're seeing lack of call buyers, but also lack of put buyers as well, in which case the VIX kind of idles in this range. Again, as the puts have gotten a bit more expensive over the past few weeks, you're seeing complacency in buying insurance, but that may also denote that there's lack of upside bets being made as well. So we're seeing lack of upside bets and downside bets, which leaves us in this narrow range between 15 and 18-ish on the VIX. Again, we probably need some kind of exogenous event to occur that would spur a larger move up on the VIX and a correlating decline in broad markets. So I don't really put much weight overall into the VIX, bouncing around this range. But again, if we see a break above 20, that's when I would probably be more averse to taking long positions, perhaps, and maybe more inclined to sell some premium. And likewise, if we see a decline below 15, I think it's probably going to indicate that we're going to push back up toward that 4,600 recent high mark on SPX. Now, moving on to page 7, we have the US dollar index. What are your thoughts here?
Well, the strength we're seeing is definitely impressive, and it's consistent with the Fed minutes, echoing what I've said right here on MacroVoices for many weeks now, which is the market has been assuming that a dovish pivot or some end to rate hikes is certain and imminent, when neither of those things is really true. The dollar is telling us that the market has finally woken up and realized that its fantasies of a dovish pivot were unrealistic. But the critical question is whether this strength in the dollar is temporary or if we're headed towards, a new trend to 116 or higher on the Dixie, which was the previous high. For now, I'm still leaning toward the idea that the high is probably already in, but a sustained move over 104 on the Dixie would force me to reevaluate that view. So let's see if we take out 104, which has played a very important role in this market, both as support and resistance in various moves over the last several years.
Eric, it has to be impressive, the fact that the U.S. dollar recovered to the degree it did. When that July breakdown occurred and it broke to a fresh new 52-week low, it really looked like a U.S. dollar floodgate could have opened. My thesis all year was that we would have far more of a trade range-bound dollar going into some sort of economic slowdown. And that breakdown really was making some big questions as to whether or not there was still more downside to come. But the fact that we've seen such a strong recovery in the dollar, where wiped out now the entire downside sell-off and put it right back into that trade range. My trade range is in that 101 to 105. I know you're mentioning the 104 level because of the May highs, but to me, the dollar is now back deep into this trade range that we've been in all year. And if we continue to see the pattern that the consolidation stays in this and old dips are being bought, particularly if we see any period where the euro sustains below 109, while we see right now the US dollar yen ripping to a fresh 52-week high. We see the US dollar against the renminbi at a fresh high. This is an environment where the US dollar is actually gaining some short-term traction. And I'll be really curious if that by September it leads to some bullish price action, which I would not yet want to say with confidence is here. It's simply a recovery, but it's certainly a much different dollar chart.
Now on page 8, we have the gold futures chart. What are your thoughts here, guys?
The spot price of gold traded below $1,900 on Wednesday, although the December delivery contract in the futures market, which is what most of the charting programs quote as the current price, is still up around $1,925, thanks to steep contango in the market. I think we have lower to go before this correction is over, and the reason is exactly what we just covered on the dollar. The Fed is going to continue hiking as long as needed to fight inflation. And when the market convinced itself right after Silicon Valley Bank failed that surely the Fed would never hike rates again, that's what took us up to retest all-time highs. I think what it will take to break through those highs into a new structural bull market is for the end of rate hikes that the market already duped itself into thinking has already happened. That needs to really and truly happen for real, I think, before gold really moves to new all-time highs and we really get a serious bull trend in play. And I think so far it's been false alarms. So let's wait until the Fed actually tells us that they're done and they actually begin a campaign of cutting rather than hiking rates. Until then, I still see plenty of room for still lower numbers before this is over.
Eric, there's no other way to put it, but the price action on gold has just been so incredibly weak. It's been so distributive. The sequence of lower highs and lower lows is so evident. Distribution is still happening. This is an environment where obviously interest rates are rising, and at the same time the dollar is strengthening. Just everything is signaling the window from which gold traditionally does well. I would imagine that the next major kind of bull sequence in gold will likely line up when we have an easing cycle on the monetary policy side, which at this moment seems a distant part into the future, maybe something that isn't even in 2024 story. Point is, right now, it coming down to that 1900 level on that December contract is really the path of least resistance, and we'll just see where it finally settles in from all of this distribution. Nonetheless, I wanted to just touch on two other quick charts. I wanted to touch on the uranium U3O8 contract futures. We are 50 cents away from it breaking above that May-June high. And it'll be really interesting to see if it does manage to break that and head over to last year's highs, which are much closer to the $63, $64 level. Uranium has been in a very distinct uptrend, and it's one of the few things that continues to work in a market that is very heavy and distributive. And the last chart I wanted to touch on is that 10-year Treasury note futures. Obviously, most people look at the yield now trading at that 4.25 or higher level. But we now have obviously the reciprocal where the 10-year yield is trading right back to those October lows. And the bigger question is, who will prevail? There's some very big names that came in there with some very aggressive shorts on these bonds, betting on 5% yields. But when I really kind of step back and look at where we are in terms of the economy, where we are in the monetary cycle, where we are in all of these different elements, I find it a very difficult time on a macro space to be overly bearish bonds. And I'm actually suspect as to whether or not this ends up being a bottoming formation that falls off here. Now, we're selling right into it. It's such an early moment to even stick your neck out to make that call. But this is such an important crossroad right here on the 10-year bond futures, and you just have to watch. It's going to be really, really interesting what happens in the week to come.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.